Welcome back to another episode of the MD Investor, the channel where we're talking about personal finance. We take it seriously. We're passionate about it. We're about setting goals, achieving goals, educating ourselves and our children so we can break the cycle of generational poverty. New video today, guys. Today's video is going to be on back to school, lesson on index funds. We've done lessons on stocks, bonds, mutual funds, stock market sectors, ETFs, and today's lesson is going to be on index fund. Before we're going to do a lesson, if there's people out there you think could benefit from the information, let them know. Friends, colleagues, family, whoever, let them know about the MD Investor. On YouTube, it's MD Investor. On Instagram, it's MD Investor1. Index funds, what are they? Index funds, basically, the term fund or the word fund suggests it's a basket of stocks. So basket of stocks or basket of bonds. So basket of investments. And it tracks or follows an index. Okay? We can't talk about index funds without this man here. This is John, aka Jack Bogle, the founder of Vanguard. He is credited with inventing or creating the first index fund, I think back in 1975. Now we're so used to index funds, but back then everything was actively managed mutual funds, paying large fees, and he was really about returning the fees and all that money to the shareholders so they can profit. It says here, Vanguard, that Jack Bogle wasn't a billionaire. He was proud of that, right? Now in this day and age, right, you're a money manager, you're gonna be a billionaire, right? He wasn't, and he was proud of that because he was, he was believing in charging low fees so that the investor, us, you, can profit. Um, okay, so what is an index? We talk about that. We talk about that all the time. An index is basically it's like a measuring. It's like a unit of measure. It's like we're measuring something, like almost like a thermometer. Right? You want to see how somebody's temperature is. You take a thermometer and you kind of check. Oh, you're too hot. You're too cold. You're so and so. So the S&P 500 is an index of the 500 biggest companies in America. And there's other indexes. There's the Dow Jones. There is the Russell 3000. There's a lot of different indexes. So it said the S&P 500, or simply the S&P, is a stock market index that measures. Here we're talking about that measures the stock performance of 500 large companies listed on stock exchanges in the U.S. So that's what an index is. Okay, so you can measure the 500 companies, biggest companies in America, using an S&P 500 index, almost like a thermometer for that market. You want to measure you want to measure the total stock market, then you can measure a thermometer. You take a thermometer to measure maybe the CRSP, total U.S. stock market. So that'll measure the total U.S. stock market, meaning the 500 largest, and some of them that are not in the 500, and the medium and the small. That'll measure that market, okay? So an index is basically like a measuring tool to measure the underlying financial market, okay? So if you have a S&P 500 index fund, it's basically a fund that mimics or trying to reproduce that underlying market, okay? Like we said, there could be other indexes. S&P 500 we talked about. That's the one that people mainly talk about. The Russell 3000 we mentioned. The CRSP, total U.S. stock market. Okay? And as I said before, an index fund is basically a mutual fund that imitates the underlying financial index. Okay? So an S&P 500 index fund will mimic the S&P 500, meaning if the S&P 500 is going up, then the S&P 500 index fund, which is mimicking it, will also go up. If the S&P 500 goes down, the S&P 500 fund, which is tracking or mimicking it, will also go down. Okay, it's almost like in sports. In sports, you have like the wide receiver and who's on offense, and you have the defender, which is like the cornerback, right? And the cornerback is basically mirroring the wide receiver. The wide receiver is running fast. The cornerback is also running fast. The wide receiver is making a left turn. The cornerback is he's tracking him. He's tracking him. He's tracking him. Whatever he's doing it. Okay, so that's kind of a way you want to think about it. Now, a lot of time when people get into investing or when they're first learning about investing, they think, I'm just really not smart enough. Maybe I just don't have the underlying foundation. I don't really know these financial terms. I'm really not qualified, and so on. And they get nervous. I want to start, but I think I don't know enough. I need to read more. What they call analysis paralysis, right? They want to make a move, but they can't because they feel like they don't know enough, and they keep waiting and keep waiting. Analysis paralysis. A cure for that is an index fund. So while you're thinking, I really don't know enough, I want to wait, I'm thinking about investing over here in McDonald's, but I don't know. Maybe I should invest in this. I don't know. The cure for that is an index fund, right? You're not sure. Why not just invest in the total market? Easy, right? Set it and forget it. We know that the stock market generally goes up. Here it says here, we say here, the average annual return and compound annual growth rate of the index, talking about the S&P 500 index, including dividends, since inception in 1926 has been approximately 9.8%. So when they say the market returned about 10%, they're talking about the S&P 500 index. See that? It returns about 9.8%, or about 6% after inflation, right? Because inflation is about 3 to 4%. Okay? So that's what they're talking about. So if you're worried that you don't really know enough, you want to wait, and so on, just get an index fund. Okay. Now, one of the benefits of index fund is that, especially for beginners and probably other people too, it saves time, right? Because you think it would take me months to start getting myself up to speed and start studying and learning how to analyze charts by index fund. Every month you keep adding money to it, so it saves time. It gets you into the market. So look at some of the pros. Some of the pros of buying an index fund. One, it's passive, and you compare that with or contrast that with an active mutual fund. So it's passive, meaning there's no fund manager trying to pick winners and losers. Should I buy Apple or should I sell Apple? Should I buy Home Depot or should I sell Home Depot? There's nobody doing that. They're basically just tracking the index. Okay, so it's a passive sort of way to invest. Another advantage of index fund, it's inexpensive. We'll get to that a little later, but the expense ratio is much cheaper. Something like VTSAX, Vanguard's total stock market index fund, expense ratio of 0.04%, which basically means that it's going to charge you or cost you 40 cents for every $1,000 you have invested. Very cheap. It's convenient, right? The one-stop shop. You buy that index fund, and you have that whole market, whatever the index fund is tracking. You have the whole thing. You get immediate diversification, and you could also do auto contribution, right? So you can say, give me maybe $100 a month. I'll contribute to it once you have met the threshold. Because sometimes, like we talked about with some of the mutual funds, a lot of times you have to have a certain threshold. Like with Vanguard, a lot of times it's $3,000. But once you get that basic threshold, then you can do automatic deposits, say $100 a month or whatever. Which is one of the cons to the index fund is that there could be a barrier to entry of say $3,000. Okay, but otherwise the index funds are a great, excellent way to go. That can be your total stock, your total stock in your portfolio could be index fund. You can get maybe a bond index fund and a stock index fund, and that alone could be your whole portfolio. I mean, it's really amazing. Let's look at some stuff here, which I think is gonna help to explain. Let's look at a actively managed mutual fund. This is this is the American Funds Washington Mutual Investor Funds. The reason why I mentioned it is I actually had this in my portfolio. This is years ago before I was really into this stuff. Didn't know what it meant. I had it in my portfolio, right? Which was kind of, I don't want to say pushed on me, but recommended to me. Let's put it that way, okay? Now look at this. American Funds Washington Mutual Investor Fund. Let's go through this. The ticker symbol, AWSHX, is traded on the NASDAQ. This is the last trading price, $45.42. Let's go down here to some key stats. Before we go to these key stats, look at this is the 1 year chart, right? So this the price up here is about $45, and here, right, in March we have this big drop down to about $52. The big drop down here. Correction, the big drop down to maybe about $32. It's probably the beginning of the pandemic, right? And now it's been slowly rising. Okay, a couple of things to look at. One, look here at the expense ratio. See here? So you see the expense ratio here is 50.58. And we say this is, you compare that to an index fund like from Vanguard, which has an expense ratio of 0.04. So 40 cents for every $1,000 you are investing. With this actively managed mutual fund, here we have an expense ratio of 0.58, which means you're going to pay $5.80 for every $1,000 that you're invested. So immediately you see already the cost is multiple times higher from the expense ratio. That's one thing. And that alone is over 40 years, it'll cost you a lot of time. Remember we did a story on an expense ratio of 1% over a 40-year period will cost you about $560,000 in fees, right? This is less than 1%, right? But still, you can imagine it's going to cost you probably $300,000 just from this alone. And over here, we have an additional fee. Over here, you see this? Front load, 5.75%. This means for every $1,000 that you're investing, they're going to charge you $57.50. So you see that? So you put in $1,000 into this fund, right? This is American, whatever they call it here. This American Funds Washington Mutual. You put $1,000 into it. Just to be in the investment, that's what's called front load. Just to be in the investment, you are going to pay out of every $1,000, $57.50. So your $1,000 investment now get chopped down to about $943. Okay, from $1,000, you put $1,000 in. They take the $57. Let's round off to $57. You put the $1,000 in, and $57 is taken out, and now you're down to about $943. And then from that $943, we said you're going to take out about $5.80. So from the 943, you're now probably going to be down to about $938, something like that. My math may be a little off, but say about $938. So from $1,000 you put in, only $938 gets invested. So that's $62 fees. The video we did in how does your investment advisor get paid? Are they such a nice guy? They want to do you a favor? No. This front loaded fee will be split between the manager, the fund manager, and your investment advisor who recommended the stool pigeon, recommended you, the investor, to this fund. Okay? So $1,000 were given. And you doing your thing, right? You working, you have it on autopilot, you contributing money and everything. You're like, oh man, I'm doing good. My future's gonna be bright and rosy. However, what you don't know is that out of the $1,000 you're giving, about $62 is being eaten up, will not be invested, will never be invested, will not profit you one bit. And that's why an actively traded mutual fund, an actively managed mutual fund and an index fund, even if the performance are the same, we're both getting 10% annual return every year, 10% or 12%, whatever it is. Because their fees are so low, they're only paying 40 cents per $1,000, and you're paying so much, right? In this case, what you're paying about $62. You can't compete. They're paying 40 cents per $1,000, and you're paying $62. You can't compete. And all those fees over 40-year investment career, that's $62 every $1,000 or $62 being taken out. That's going to compound. That's why when they say over a 40-year period, paying a 1% fee or whatever, you end up losing about $560,000. The numbers don't lie. Now let's look at an index fund by Vanguard. So these are the Vanguard's total market index funds. They have total bond market index Admiral shares, and usually Admiral shares you have to have at least $3,000. But let's look at the total stock market index Admiral shares VTSAX. Okay, the large cap blend. Look at the expense ratio, 0.04%, because it is not actively managed. See that? So only 40 cents per every $1,000. Let's take a look at that. So Vanguard Total Stock Market Index Fund Admiral shares, ticker symbol VTSAX. And here you see where it said it's also available as an ETF, starting at the price of one share. In the last video, when I did the lesson on ETF, we said sometimes because these are mutual funds or index funds may have a minimum investment. And here you can see minimum investment $3,000. If you don't have $3,000 but you want to be exposed to the total stock market, what do? You have an option. The option is you can buy the ETF, which is VTI, and cost of one share I think is about $168. That's the option. Now let's look at the product summary. Created in 1992, Vanguard Total Stock Market Index. So you notice the index fund where it says, obviously the word index. They'll say stuff like index. They'll say stuff like tracks or underlying index. So Vanguard Total Stock Market Index Fund is designed to provide investors with exposure to the entire U.S. equity market, including small, mid, and large cap growth and value stocks. So this is total market, as opposed to an S&P 500 index fund, which will only expose you to the large cap. S&P 500, the 500 largest companies in America. But the total gives you everything, small, mid, and large cap, growth and value stocks. When I say growth and value stocks, growth stocks meaning stocks like Amazon and Google and Netflix they don't pay dividends, but they're basically growing. They're growing. Value stocks are like more established companies. They're not really growing as fast, and they typically pay dividends, like McDonald's and so on. The fund's key attributes are its low cost. All right, we said that. Broad diversification, we're going to see that in a minute, and the potential for tax efficiency. Um, Investors looking for a low-cost way to gain broad exposure to the U.S. stock market who are willing to accept the volatility that comes with stock market investing may wish to consider this fund as either a core equity holding or your only domestic stock fund. Okay, so you can use it as a core equity or core stock position, or it could be your only position. So expense ratio we mentioned very low. It's a category of large blend, right? So large cap. It's domestic. Just U.S. stocks are here. There's a minimum investment of $3,000, but you can get around that by buying the ETF version, starting at one share. The risk potential they have is more risky because it's all stocks. There's no bonds. And look at the performance here. You have the total stock market index in blue, and the benchmark, the spliced total stock market index, which is in beige. And what you're going to see that it basically tracks it perfectly, like the wide receiver and the cornerback. It tracks it. Whatever they do, you do, because you are basically a mirror of it, right? And this will explain it. This is the composition, the portfolio composition, and this is going to look similar to the ETF version, the Vanguard Total Stock Market ETF (VTI). It pretty much looks similar, right? And that's why they said you have two options. If you have the $3,000 and you want to do auto invest after you have paid your $3,000 minimum investment, then go with the index fund. If you can't afford the $3,000, then go with the ETF version. This is the underlying index, CRSP, total U.S. stock market. It is 2% basic material. So the index fund, total stock market index fund, is also 2%. Consumer goods, the total stock market index is 8.3%. So they made the Vanguard total market the same. Identical. They made it completely identical. Industrial, the index is 11.80, but industrial is 11.70. Not significantly different. Pretty much identical. That's why whatever happens to the market happens to you. You are the market. Top 10 holding. Again, we're going to go through this a little fast because this looks very similar to the VTI, the ETF version. Top 10. Apple, Microsoft, Amazon, Alphabet, Facebook, Berkshire, Hathaway, Johnson & Johnson, Tesla, Visa, Procter & Gamble. And the portfolio holding, the index, it had the same. This is just like the VTI or the ETF version. About 3,500 holdings, almost 3,500 holdings. Again, the same top 10. Apple, Microsoft, Amazon, Facebook, Alphabet, Johnson & Johnson, Berkshire Hathaway, Tesla, Visa, Procter & Gamble. So you're broadly diversified, okay? MasterCard, Home Depot, United Health, JP Morgan, Verizon, Walt Disney. Again, you have the entire market, okay? So after you put your $3,000, if you want to do the Admiral share in Vanguard, then you can set up automatic contribution, $100 a month, $200 a month, whatever you want to do. You have everything. Coca-Cola, you have the entire market. This is broad diversification, okay? You will be spread thin. If one market is down, if one segment is down, like say financials, then consumer staples are probably going to be up, okay? You'll be well balanced. You have 3M. You got everything, Boeing, everything, just like in the ETF version. So, guys, just a quick video, again, to increase our financial intelligence. So we can kind of be aware when we hear these terms. Index fund. What is that? So you can buy an index fund that tracks the S&P 500, right? You can buy an index fund that tracks the Dow Jones. You can buy an index fund that tracks the total stock market, and so on. Okay, so if there's people out there, guys, you think could benefit, let them know about the investor. Send them the link. Like I'm telling you, this stuff is very important. You saw that example I showed you with an actively managed fund, right? I was in that fund for a long time. My financial advisor was saying, listen, I'm in that fund myself. So didn't really, I didn't really understand that this fund It's costing me money. The performance is not any better. And even if these actively managed funds are able to beat the market 1 or 2 years in a row, they're not able to do it over the long period of time. And even when they're failing or not able to match the market, right? Or what they call underperform the market. When they're underperforming the market, they don't say, okay, you know what, we underperformed. We're not going to charge you this fee. They still charge you, right? Can you imagine that? If I am charging you for something, but I can't deliver, but I'm still charging you, right? I go to a restaurant and I order a meal. The meal, which is what they promised to give me for the money I'm going to pay them, but the meal never shows up. But I still got to pay. That doesn't seem right, right? I'm leaving hungry, but I still got to pay you, right? I'm paying you um, money for the expense ratio. I'm paying you money for the front, in case of the front loaded mutual fund, right? Just to be a part of the fund, I got to pay you. My return is not guaranteed. And I'm going to do this over and over for decades and decades. And instead of ending up with $1 million, maybe I'll only end up with $400,000 or something like that. I'm just saying that it's going to cost me, but because of lack of financial um, intelligence, right? Um, Being financially savvy and knowing some basic stuff. I'm not talking about advanced stuff. Knowing some basic stuff. I can say, what about an index fund? Why don't I take? And that's what I did in 2018. Took my money out. No more actively managed fund, and I'm gonna go on my own with an index fund. I decided to take action. Okay. So again, guys, thanks for the support and continue to command your money to grow. Remember, the past is gone, and we can do nothing about it but learn. And the present is here, and we have to plant seeds so we can have an exceedingly and abundantly great future, which is what God has promised us under the sun. I will see you on the next one.